Justin, very good to see you. I'm really glad you have time to talk today because we have a lot to digest. Of course, the big, beautiful bill recently passed. I know, again, you specialize in tax planning, so you've been diving into the nitty gritty. I want to talk about the big takeaways that we all need to know about. And there are several, but you and I were chatting because over the weekend, we both got an email from the Social Security Administration talking about how the bill's changing that. What do we need to know?
Okay, so great question. And I feel like the Social Security Administration is trying to get out in front of things. They sent everybody an email that said, hey, 90% of Social Security beneficiaries will no longer have tax on their Social Security. So, of course, everyone got very excited and rightly so about that. But unfortunately, the bill doesn't contain anything about taxes on Social Security. It
Okay.
it does, however, provide a $6,000 additional deduction. So just imagine you're getting a standard deduction for that comes off of your tax bill. So if you made 100,000, let's say, and your standard deduction is 30,000, the taxable income is 70,000. What the bill now says is that if you're 65 years or older, so if you're married filing jointly and both of you are 65, you get $6,000 each or $12,000 in addition to that standard deduction. So again, going back to our example, if you have 100 grand, 30 comes off for the standard deduction, another 12 would come off, giving you $42,000 of deduction. So your taxable income would then fall to whatever's left over.
Interesting. So a little bit of spin on that. I'm glad we got to dive into the details then.
Exactly.
Now let's talk about some, a lot of us, we're homeowners, and there are some very specific changes if we are homeowners. What do we need to know here?
So for the homeowners, I think one of the biggest things is the solar credit is going away. So it was 30%. So again, if you spent 100 grand, just use those easy numbers on solar panels and installation. Your tax credit would have been $30,000. And if you didn't have enough tax to use up that $30,000 credit, it would carry forward to future years. That is going away. So this is the last year. If you were thinking about doing it, of course, there's going to be incentive to do that before the year ends so that you can get that really nice 30% credit. And if it's okay on that subject of energy efficient things, the vehicle credit, the electronic vehicle credit,
Right.
also going away as of this fall. So again, a little incentive if you're going to do it anyway. You might as well do it when you can get a credit.
Right. That runway is ending. Okay. So then what else are the big tax takeaways?
So for tax takeaways, I think one of the biggest ones is that the tax brackets from the 2017 Tax Cuts and Jobs Act, which originally lowered the tax brackets, or lowered the tax rates, I should say, is now here to stay. So that was made permanent. Of course, these will be adjusted for inflation each year, but that was one of the main things. So they've extended those lower tax rates. Another thing that we can take away is that for those who like to give charitable contributions, a lot could not be deducted after the 2017 Tax Cuts and Jobs Act. Very few people itemize anymore.
Mm-hmm.
So, but now those who take the standard deduction can get a $1,000 deduction for charitable giving, and that's per person. So if you file jointly, that's $2,000 of charitable giving that can now be deductible. A few other things for babies born 25 through 28, there will now be a Trump account available, which the government will deposit $1,000 to that Trump account. And one of the other things I wanted to mention is no tax on tips or overtime,
Right.
but
That's a big deal.
there is some fine print on that one. So
Okay.
those get phased out over a certain amount. So it also has to be qualified tips and qualified overtime. Of course, $1 million question. What does qualified mean? We are waiting for Treasury regulations to help us with that. But the phase outs are at 150,000. So
Mm-hmm.
if you have tips or overtime that you're planning to be tax free, but you make over 150, that's going to get phased out. So then you wouldn't be available to take advantage of that credit.
Okay, so Justin, I'm glad that you were able to talk through the changes. And I think the other big takeaway for people at home is essentially the extension of the 2017 tax cuts, which you mentioned. So we are living in a historically low tax rate right now. So even though all these changes are kind of coming, now is still a good time for people to be considering Roth conversions. Explain why.
Okay, so a Roth conversion, there's several reasons to do it. It's just a quick refresher. The Roth conversion takes pre-tax accounts, which is maybe think of your 401k or your IRA, and you convert it over to a tax-free account.
Mhm.
But just as a full disclosure, you pay tax on the conversion. So it's tax-free once it hits the Roth. That means if you transfer 100,000, you pay tax on the 100,000, and then you have, let's say, 80,000 over here after taxes. That 80,000 could grow to a million, and when you take the million out, it's tax-free at that point.
Mhm.
So the Roth conversion is really, really valuable if you have all of your money tied up in pre-tax accounts, because when you take that out in retirement, then your Social Security gets taxed, as we just ran over. That's not changing. So it's based on something called the provisional income formula, which is just a fancy way to say some, half, or 85% of your Social Security gets taxed based on how much you make.
Mhm.
So a Roth conversion has other benefits, maybe like lower Medicare premiums. And if you ever have the devastating misfortune of losing a spouse in those years, it could really do damage to your nest egg if all of it's tied up in pre-tax accounts. So that's another, often called the widow tax.
Right.
So that's another big reason that, it's a nice time to think about those Roth conversion and other tax planning mechanisms.
Right. That runway has been extended. Other runways have been shortened. So now is the time to speak with somebody so you can really sit down and crunch the numbers. So, Justin, if somebody wants to have that conversation with you and do the math, what's the best way to reach you?
Sure. They can reach out to us through our website at arnoffromo.com, contact us, or they can give us a call, 530-300-0066.
Great. Justin, thanks for your time today.
Thanks, Aaron.